test.
Test. I guess you can hear me now.
Test.
You see what Pushy Creek passed away.
I did, yeah.
I couldn't believe it. I didn't realize he retired. This board pretty much shows the first of everything. Or, I hit, I got my 35 year pen.
You did?
I did. Wow.
I was gonna say,
Seems like yesterday I got my 30.
well, I don't think we're gonna make that. Yeah. Okay, good morning. I'm told we are all set. Everybody's hooked up, logged in, and ready to go. So I will call the meeting to order. Item number 2 on our agenda is to approve the minutes of the meeting of December 10th, 2020. Have a motion and a second. Please record your vote. Item is approved unanimously. Item number 3 on the agenda is the consent docket. We can take these with one motion. We have 3 items. I have a motion and a second. Please record your vote.
Mr. Chairman, I think our accounts were going to do a brief presentation on the CAFR.
Okay, is that the next item? We're still waiting for the vote. We're still waiting for, oh, it's on item, okay. I'm sorry, okay. We have a brief presentation on item 3B, the CAFR for,
Yes, this is Anita Benton, who is with our accounting services.
Good morning. Good to see everybody. Yes, I want to present a little slight summary of our CAFR for the year, the Osage Justice. Everybody have got a copy of one of these, right, for 6/30/20? And we are pleased to announce that we received an unmodified opinion from our auditors again this year, which is the best you can get. So we're still on a roll with that. And if you would like to read the auditor's opinion letter, it is located on page 11 in the booklet. And then the next thing I would like to direct you to is on page 17, the statements of fiduciary net position. You can see at the bottom the amount that we had for our net position was $755.4 million in 2000 at 6/30/19, and at 6/30/20 we had $760.4 million, which was an increase of $5 million. And then on the very next page, I can show you our total contributions were just over $16 million. Our net appreciation and fair value of investments was almost $30 million, and that is offset by our benefits that were paid of $39 million, which that primarily makes up that $5 million increase there. And then the last thing that really is, I think, important for you to see is on page 40, and that is in the notes to the financial statements. And this is, we had a change in assumptions, and I believe Louise addressed this in August or July at the July meeting when she presented the actuary report. Our change in assumptions caused our net pension liability to change to a net pension asset this year. And you can see just a little ways down in the first chart, it shows planned fiduciary net position as a percentage of total pension liability. That's essentially the funded ratio. Went from 101.3% last year to 94.14% this year. And that is due to that change in assumptions of just over $34 million. So I just wanted to point that out and explain that a little bit. Really, those are the highlights. if anybody has any questions, I'd be glad to answer them.
Thank you, Anita. One thing I'd just like to point out, I really am glad, I sleep better with a 94 with good assumptions than a 101 with bad assumptions.
I
So
agree.
I can't stress that enough. So
I agree.
I think that's still a very well-funded program, and I want to thank the Accounting Services Division for doing their work with Anita and Amy Lucas, who's one of our accounting managers back there, and Matt Boggs for all their help in doing that.
Thank
So
you.
thank you.
Thanks, Anita. Okay, now we are ready to have a motion and a second on item 3.
Gina, we're not saying it.
There we go.
There we go.
There we go.
Okay.
Have a motion and a second on item 3. Please record your vote. Item passes unanimously. Item number 4 is to ratify approvals. We have 3 items. Have a motion and a second on item 4. Please record your vote. Item passes. Item 5 is to approve the claims docket. Have a motion and a second on item 5. Please record your vote. Item passes. Item 6 is to approve the following applications for service retirements. We have several. Have an item and a second. Please record your vote. Item is approved unanimously. Item number 7 is to receive report of death, authorize payment of the $5,000 death benefit, and approve continuation of pension to spouse. Have a motion, a second on item 7. Please record your vote. Item passes unanimously. Item number 8 is receive report of death, authorize payment of the $5,000 death benefit, and authorize secretary to make necessary changes to conform on the following. Have an item and a second. Please record your vote. Item passes unanimously. Item number 9 is to receive the report of death, authorize secretary to make necessary changes to conform on the following. Have a motion and a second. Please record your vote. Item passes unanimously. Item number 10 is items for individual consideration. Item 10A is the interest rate to be applied to eligible portion of employee contribution account for the period of January 1, 2020 through December 31, 2020. Have a motion and a second. Please record your vote.
Chair, I'm sorry,
Yes, sir.
what rate are we going to apply?
We are going, let me find my,
Maybe my question is more for Francis. Does someone need to move the rate?
Yes, it
I-
needs, fill in the blank.
I move that we apply 0.13%.
okay.
I was just going to add that that was the 2-year Treasury rate that I included in the packet was 0.13.
Okay, I have a motion and a second. Please record your vote. Item is approved unanimously. Lost my agenda here. Item 10B is to grant a cost of living adjustment to eligible retirees and providing an effective date. We just got the CPU or the CPIU information in yesterday, and our policy says it's the not to exceed the lesser of the change in the CPI for the period of December 19 through December 2020, or 2%. And Regina, I've lost that number. What is that number again? Oh, okay.
I had just emailed you yesterday. It's 1.4% is the change from December to prior December, so 1.4.
So it'll be 1.4. That's the lesser of the CPI or the 2%. So
Effective date.
the effective date would be January 1st. We'll retro it back on, yeah. Okay.
Need a motion.
I need a motion in a second. Motion a second. Please record your vote. Item passes unanimously. Item number 11 is our investment consultant report. Good morning again.
Good morning. Very happy to be here. Good to see you all in person. It's been certainly been a long, strange year that, I'd say we'd all like to forget, but it's certainly one we're not going to forget. A lot of lessons learned. We've probably all evolved in ways that we never thought we could in our working environment, and how we just deal with things from day to day. I'd say the one thing that is probably more true this year than any other I've seen in my years in the business is how important that mantra of sticking to the plan is. Something as unexpected as this pandemic, came on, as I mentioned to a couple of you earlier. I think your meeting in March was the last meeting I went to, and that day my meeting for the next day was canceled, and I went home and would have never anticipated what the next 9 months looked like. And as we saw what was happening in markets over the last few weeks of February and the first 3 weeks of March, 40 to 50% declines in equity markets, the GDP plummeting. If ever there was a time to react and change course, a lot of folks might have thought to do that then. But as we've told you, and you've been very consistent in this approach, this is a long-term pool of assets with long-term liabilities. And so sticking with that plan is important. You have things in place in your portfolio to provide protection when markets go down, really to provide protection for when markets go down over a longer period of time. Those things did work, but also having to make sure that you still have sufficient risk in the portfolio to participate in rebounds. I don't think any of us could have said at March or April that you would have 16.5% returns this year in 2020. But the portfolio did, and markets have done very well. Really fueled by monetary easing and fiscal policy. As we sit here today, though, looking at these very good results, I think, as Brent pointed out, lowering assumptions, you guys have been very good in taking a conservative approach. We have been, our message each year the last probably 6 years has been for a muted return environment going forward. And that hasn't changed based on where we are today. It's even more so. Our 2021 capital market assumptions for the intermediate time horizon, the next 5 to 10 years, are down about 1.5% to 2%. So looking at equities broadly with low 5%, mid-single digit returns, and fixed income, in the 1.5% to 2% range. So when you think about a portfolio that needs to get now a 7% return, that's going to be challenging over the next 5 to 10 years. That's not to say that you just abandon what you're doing. I mean, equities still, on a relative basis, look more attractive, although valuations are high. There are certainly pockets of opportunity. The breadth of the returns in capital markets globally this year has been really from the end of March through the end of September, was pretty limited to the technology and more growth-oriented sectors of the market, the companies that were really benefiting from a stay-at-home economy. We saw the top 5 names in the S&P 500 made up about 50% of the return of the S&P 500 for the year. That's your Netflix, Amazon, or Apple, Alphabet, or Google. Although that has really turned over the last quarter with positive vaccine news, at least initially, that there were vaccines coming to market. We've started to see a turnaround in areas of the market that really haven't participated, the more cyclical sectors, value-oriented sectors, which we believe there's opportunity there. As we look at your portfolio results, I hesitate to say this, but I have not seen in 20 years a portfolio on a one-year basis that has done this good on a relative basis. Really, everything worked over 2 time periods. And we don't expect to see this not just on an absolute basis, 16.5% returns or 16% net of fees, where your policy index is up a little under 12%. So the policy or the markets delivered, but your portfolio delivered quite a bit more. And really there was a few areas that contributed to this. Within large cap, where you're mostly passive and you take on some active risk with the Intech portfolio, Intech really benefited in the second half of the year because that strategy that invests in large cap names tends to overweight the smaller companies within the large cap index because it's a mathematical approach that captures volatility. The names that tend to be more volatile in large cap space are the smaller companies, not small cap, but smaller companies in large cap. But that helped in the second half of the year where you really, you're adding almost 4% relative to the S&P 500. So big positive from really the largest part of your portfolio. Within small cap and international, you really benefited from not a growth bias necessarily, but the value managers we have in place there are certainly not deep value. They're very relative value. Lazard on the international side is really, we'd consider them a core manager with a value tilt. And so not having that deeper value bias helped. The growth manager, Harding Loevner, did very well, better than the growth markets, and your value manager performed really in line with the broad market. In small cap US, the same thing happened. Times Square on the growth side, they did very well in a growth relative to the growth benchmark. I say very well. They added about 50 basis points, but they were up 41%. And growth was up 40%. But Earnest Partners, you'll see they're up 20.5%. They are a relative value manager, so they do look for value, but they are also looking at certain growth characteristics. Over time, they tend to do not as well in a really contrarian deep value environment, although the last quarter, where we really saw the cyclicals and value outperforming in November and December, they did a nice job. The third quarter or the fourth quarter of the year, they're up 27.5%, slightly trailing the value benchmark, but still doing well. Your emerging market managers, we have a combination of a core manager in Wells, Berkeley Street, and then a small cap manager in Wasatch. They tend to be a little bit more growthy. That is a small position. It's 1.5% target in the portfolio, but it's really there to provide incremental return in periods like this, and they did a nice job. So really you're seeing returns coming from across the portfolio. At the end of December, as I said, you finished the year at $867 million, I think. I'm not sure if that was June report. Your CAFR was for June, and so you're up about $100 million from that point in time, that six-month period. So you can just see from a pretty dramatic increase on a dollar basis. At the end of the year, we're a little bit overweight to equities, which we would expect, slightly outside of the range. Talking with Regina and Matt, we've been raising about a quarter's worth of cash just to be cautious because things have been so volatile. We're going to propose that again, so we'll raise money from small cap because you're about 4% overweight there, and it will be from Times Square because the growth is overweight to value. We're going to raise about $10 million to get you to 3 months worth of cash. I don't think any further rebalancing is done. It needs to be done. When we add cash to fixed income, that'll get you closer to the target, and it'll bring equities under that 65% cap. That said, next month, I would like to just revisit asset allocation, just showing you where we are with your current mix relative to what our 2021 capital market assumptions look like. And one of the things that I think we may want to consider is bumping up the strategic target to equity, a 60% target to equity in this low return environment where we have expectations, like I said, in the 5 to 7% range. We think we need to bump that up a little bit. And so we'll look at some ways to do that without necessarily adding incremental risk. One area that I think we can also, not necessarily a wholesale from fixed income to private equity, but private equity currently of a 5% target. As we look forward, that is an area where longer term we do expect incremental excess return from private markets for investors that can take on that illiquidity. One of the reasons why we're at 5% target and not 10 is because it takes time to get to your target in private equity. You've been building the private equity program for a little over 10 years now, and you've reached that 5% target. We could bump that up a little bit, and that's one of the things we'll want to look at. So again, just in summary, number one, happy to be here. Good to see you all in person. Done a lot of Zoom meetings and things. Commend you for the decisions you've made and sticking to your knitting and being thoughtful about your actuarial assumptions that you're using. But we want to be vigilant and looking forward, and I think next month just revisiting the asset allocation and just for more than anything else, just establishing expectations and making sure expectations are reasonable, because we don't expect things to look like they've looked the last 10 years where you've got a 9% return. And I think you all are certainly there with what you've done with your assumptions, but it's good to reinforce that. From a manager standpoint, the PAMCO liquidation and redemption continues and you're funding PGIM, the Prudential liquid absolute return strategy. A big portion of that was funded in the fourth quarter, beginning in September. That liquidation from PAMCO will continue on probably over the next several months as there's some less liquid positions that they're getting out of. Other than that, any questions today? Okay. Good to be back under the bright lights of Oklahoma City,
Yeah.
with a mask.
Thanks, Jason.
Thank you.
Okay. Item number 12 is comments from board, staff, and citizens. Anyone have anything for the good of the cause? Okay, well, thank you everyone on the board and all our staff help. This is my first meeting back under these less than ideal circumstances, but we'll take it. We are adjourned at 10:29.